Hi and hello, and thank you so much for tuning in. And if you are new, welcome to my channel. My name is Preeti Rao and I am both a real estate and a mortgage broker for close to 20 years. Now, have you noticed that the variable rate mortgage is kind of dead? Well, at least for now, because less and less people are requesting for the variable rate mortgage. And that makes a ton of sense, especially given how much interest rates went up in a very short period of time, as well as the fear now associated with those variable rates that have significantly bigger payments or negative amortization. But that being said, people who have the 5-year fixed mortgages aren't necessarily safe either, because at some point now their mortgages are going to come up for renewal and they are going to find themselves in a situation where their payments are going to go up. So this is just something that goes along with getting a mortgage in Canada. You're going to have changes in your payments over the lifetime of the mortgage. But the question is, how do you choose the right mortgage rate? How do you make sure that the mortgage that you have chosen is the right one for you? And that's what we're going to talk about in this video today. But first, you know the drill. Make sure to like, share, subscribe, tap that bell icon. It gets me motivated to keep you up to date with everything real estate. So let's get into the actual meat of this video, because I want to first and foremost start by talking about how the love affair with variable rate mortgage is now over. Now there's a new thing that's cropping up, these short-term mortgages, the 2 years and the 3-year rate mortgages. And there's no doubt that we are definitely getting a lot of requests for the 2-year and the 3-year rates. And the reason for this is quite frankly because people believe that interest rates are going to come down in the short term, and as a result they're choosing shorter term mortgages, thinking that they will be able to time the market and get a lower rate in 2 or 3 years from now. And I'm going to tell you that trying to time the market is a mistake you might not be making if your prediction is right. But the idea of just timing the market in general is a bad idea. And we've used the same framework for choosing between a variable and a fixed rate mortgage for at least 20 years that I've been in the business. And it is really simple. You choose the lowest rate you can get at the time that you're getting the mortgage. So if the variable rates are cheaper, you choose the variable rate. If the fixed rate is cheaper, you choose the fixed rate. Unless, and there's one caveat, unless choosing this variable rate is going to keep you up at night and you won't be able to sleep because you're worried about your payments going up or the interest rate going up, then you just avoid the stress, because the single biggest stressor in a lot of people's life is money and their mortgage. So the question then becomes, are variable rates actually dead? Or should you be choosing a short-term mortgage? Well, as of filming right now, the cheapest mortgage that you can get in Canada is actually a 5-year fixed. It's priced lower than all the other fixed-term mortgages, and it's certainly priced lower than the variable rate mortgage. And this is unique. This happens when we have what's called as a yield curve inversion. A yield curve inversion is basically when short-term rates are higher than the long-term rates, because there is an expectation of a recession that is going to happen in the next little while. So using our framework of choosing the lowest rate at the time you can get it and trying to take the guessing game out of it and trying to take timing the market out of the equation, well, then the most obvious answer as to which mortgage people should be choosing is the 5-year fixed rate. Now, there are some other things that come along with choosing the right mortgage, because there is a chance that interest rates could go down. So if you choose a 5-year fixed, you want to be positioned in a way so that you can get the lower rate if and when the rates start to drop. The way to do that is by making sure you're avoiding big penalties. And a known secret of the mortgage industry that if you choose a 5-year fixed mortgage at the big banks and the interest rates go down, you want to get out of that mortgage, you are going to be exposed to the biggest penalties. Yes, that's right. The most trusted banks in Canada have the biggest penalties when it comes to the 5-year fixed mortgages. So, in other words, once you choose a 5-year fixed mortgage with them, you're basically giving up all your negotiating power, and you're giving up all the ability to move to a different lender to get a lower rate, because the penalty will be so high that you have no choice but to wait it out. So positioning yourself in a 5-year fixed mortgage, usually with a mortgage broker who knows which lender have the best payout penalties, put you in the best position to get both the lowest rate now and to get the lowest penalty, so that you have the flexibility if and when those rates do go down. So if you have questions or want clarifications, please don't hesitate to call me. If you still don't know who I am, please go check my rating on Google and read my client reviews. Till then, take care. And if you found value or liked this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Make sure to hit like, share, subscribe, and the bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens a door to your dream home.